go ahead. So, guys, you and girls, you know how this goes. Probably, if you don't, I'll go ahead and say these are Q&A sessions. We organize them for the venture ecosystem and for our community. These are recorded sessions, of course. They go live on our YouTube, so feel free to then revisit and reshare. Questions are not only allowed but highly incentivized. Please do ask questions. And before you know, kicking this off, I'll just ask G, give us some house rules so everyone knows how to operate in here.
So hi guys, as David said just before, this is a Q&A session, so we want you guys to make as many questions as you can, and we will select them and appropriately shoot them to Nico when possible. You can do that by two different ways. The first is just to shoot the question in the chat, and when we will read the question afterwards, or if you'd like to ask the question in person, what you can do is write between brackets live and in caps lock, and then you write the questions. If you look at the chat right now, I have sent an example, which is live between brackets and caps lock. Nico, what do I have to pay attention when doing due diligence on VCs? And that way we will select you and give you the stage to ask a question in person. Furthermore, please, if you can, keep your camera on. It makes the session much more dynamic for all of us. And if you're not asking the questions, please keep your mics muted. Thanks.
Awesome, G, thank you. Nico, with that, I think first things first, please, for those who don't know who you are and don't know Adara Ventures, they're probably living under a rock, but can you please give them a quick rundown and a quick intro?
Thank you very much. Thanks for having me today. It's really a pleasure to be here. So my name is Nico Goulet, and I am founder and managing partner, co-founder and managing partner at Adara Ventures. We are an early stage technology investment firm. We've been around for the last 15 years. We have three generations of fund in our flagship family. 180 million under management. We've done 40 investments so far. We have 25 of those still live in our portfolio. And we basically invest in tech-first deals in the early stages, so seed, Series A, with a particular focus on cybersecurity, data analytics, MLOps, DevOps, and lately we've been doing some digital health as well. We also do some deals that combine hardware, so semiconductor deals. And one that is a big favorite of mine is a company called XYZ Reality out of London, which does construction tech using virtual reality and augmented reality particularly. So that's kind of what we do. A small team, 12 people, all based out of Madrid, but our investment focus covers Spain, Portugal, Italy, France, and the UK, pretty evenly distributed in terms of deals across those geographies. And we have 7 nationalities on the team, and a team that's currently growing as we try to scale up the firm. And that's about it. My personal background is I am an engineer originally, then was a consultant, then started Adara when I was in the year 2000, 2002.
And an aeronautics specialist, or what's it called? Aerobatics? Is that it, Nico?
That's my weekend occupation. Yes,
I love that.
I fly and compete in aerobatics.
Yeah. Okay, if you can just take the stage, then I'll say to everyone the reason why we invited Nico for this topic specifically, which is diligencing the value add of VCs, is of course that Nico is the one that brought David and I together in a way, because we met Nico at IE Business School, where he teaches venture capital in a master course there, and we felt that, or an executive course there, we've always felt that Nico is really one of the most critical thinkers out there. So when it comes to taking on the shoes of a founder and saying, okay, I'm about to raise my round and I need to diligence the value add of the VCs that are all saying the same thing to us, we're going to be there for you, then we'd love to dive deep with Nico on that specifically. David, do you want to comment or can I go on?
Go on, go on.
So Nico, if you hear that intro and we just start right from the bottom and say, I'm a founder, I'm looking to get investments or get my first investment from a VC firm, and I have different offers on the table, but I'm not really sure who I should pick. In terms of the term sheets, they're similar, but they're all saying that they will be there, and I'm quite unsure who will actually be there for me.
So I guess this is a question that comes up quite often. I think, you know, and maybe I'll try to answer as if I were a founder, which is I have been a founder in the past and I have tried to raise money, but as a VC, it's been a while since I was in those shoes. So if it were me, I would be very much focused on the people. So just remember, when you engage with a VC, you're engaging with a set of individuals. VC firms are a little bit like, I don't know if you've noticed, but if you look at dogs in the street, the dogs and the owner tend to look the same as they walk down the street. The VCs are the same. So VCs very much look and feel like the partners in the firm. And, you know, sometimes there are VCs that have a strong weight from the name. So, you know, if you've got Andreessen Horowitz, or you've got Kleiner Perkins or Axel, or, you know, any of the big names, and you are fortunate or maybe not fortunate, if you've got a term sheet from them, you're probably pretty good. The weight of the name will be strong, but at the same time, you really need to focus on who is going to be with you through the journey, because the journey is going to be full of times when you really need to rely on the relationship that you have with the individual, and the personal relationship that you're going to have with the individual. And so I think that you need to focus on who is going to be sitting with you, and within that, what are the qualities and characteristics and maybe defects as well of the person that you're going to be sitting with, and try to see how those fit with you. You know, you could have a great VC that is good for one founder that is not so good for another founder. I mean, I can tell you by experience, I fit very well with some founders, and others it's been disastrous. So I think it's very important to think of the person and focus very much on the person and the way they formulate, the way they think about their relationship with you as a founder.
Maybe Nico, dive into that experience there, that sometimes it's been disastrous. So in your diligence of founders on the personal level, what is it that you're looking for in terms of your ability to connect and work well?
So, you know, our diligence of the founders is focused, obviously it goes all the traditional investment criteria that have to be checked, right? We need a big market, good tech, good, you know, all of those things that are on in all the books and all the articles are necessary but not sufficient conditions. What we think makes the difference between founders we like to work with, basically three things. One is the vision that they have, and how they formulate and articulate a vision to change the way things are done. Either, in our case, it's usually at the enterprise level, but you know, if it's a consumer play, it could be on the way consumers behave, or it could be anything. Just what is the vision driving what they want to do? It's basically the why for them. We then focus very much on their execution capability. And execution capability is generally in the details. So it's generally an issue that is more rooted in how can they get a grasp on building teams, on building companies? Do they have enough of a grasp, you know, multidisciplinary grasp on understanding enough of accounting so that when we talk numbers, they can talk numbers, enough of product development so that when we talk product development, we're going to be talking about product development. It doesn't need to be the expert in all these areas, obviously. But it needs to be sufficient there, and an ability to execute well. And good execution is really important. And the third point that's really important for us is courage. And for us, it's courage to face the risk that is inevitable in building up one of these early stage ventures. And I would say that if I flip that around and put that mirror in front of myself, and you know, I would say to the founders, maybe a way for you to think of it is to think of those same criteria for the VCs that are looking at you and with who you have a potential relationship. So, you know, this would translate into, you know, do they share your vision? Are they capable of articulating your vision in a way which is complementary to the way you do? Do they augment your vision? Can they make it even more powerful? Do they see things, you know, are they capable of enriching it for you? On the execution, I would say that, you know, what you want is for your VC to keep you honest on your execution in a way. I mean, you don't want them to be involved in the details of your product development, but you want them to ask you enough questions that they keep you on the ball and honest with respect to the things that may be happening. And in that respect, I think you can look at your VC as a big repository of experience. So sometimes I say to the founders, I say, look, you know, we are VCs. We are, in fact, we are also entrepreneurs because we're an emerging VC. You know, being on Fund 3 is still qualified as an emerging VC. So think of us as doing our Series B or Series C. And so we are entrepreneurs. You know, we founded this firm, we're building it up, and our business is simply investing in other entrepreneurs. And our vision is that, you know, we can find certain entrepreneurs in certain markets with certain products that are going to build it up. So we have all the same issues as the entrepreneur that we're talking to, just articulated around a different formulation of a vision, around a different set of execution challenges, and around, you know, the courage to implement is also, we carry a lot of risk. If we don't raise a second or a third or fourth or fifth fund, we will die as a firm in the same way any of our founders will die as well if they don't manage to raise the funds necessary to fund the business. So there's a lot of analogy, and you need to build on those analogies. And when you're talking about the execution, in the execution, you can really build up on understanding all the experiences that the VC has had. So sometimes, you know, I put it to founders as, you know, consider me as not as somebody that has wisdom, but just consider me as a library. You have a question on something, you come to me and you say, I have this question or this problem, and I can say, okay, go to, you know, to corridor 5, row 8, you know, there's a book there, which I can open on page 52, which tells you these are all the experiences we've had with this same problem. And I can share with you the experiences that we've had, and some of them would have worked out well, some would have worked out not so well. And together we can see what's relevant about that experience. So, you know, a VC, because he sees a lot of deals, and there's been, you know, the more deals obviously they've seen and the bigger portfolio they have, the better in this respect, is like a big repository of experience, not wisdom, experience, data for you about what has worked, what hasn't worked, how have different companies evolved. And you know better than anybody that sometimes the stories behind each success or behind each failure, it's not so easy to get the real story, right? Even the successes are sometimes shown as, you know, oh, I always knew that was going to work out. Or I was, you know, you hear VC saying, I knew that was a great deal. Well, that's a VC that's lying that says that, because, you know, no VC that makes a deal knows what's going to happen with a company. What they do know is that they want to embark on the journey with the founder that they're talking to. And what they know is where they're starting, but they don't know where it's going to end. And the important thing is to really understand whether you want to embark on that journey with that VC. And so the library concept is one, you know, do I want the library of Andreessen Horowitz, or do I want the library of Nico Goulet? The answer there is pretty obvious. You want the Andreessen Horowitz library if you can, but that's why we never compete with Andreessen. But if you like the library that we have to offer, you know, maybe that's positive in terms of the execution capability that we can help build. And then on the last point on the courage, you know, you need to find somebody that has the empathy with you, and measuring empathy is not easy. And we face the same dilemma. You know, when we talk to a founder, we need the founder to understand why we are investing and what our business model is as well. So the relationship with the founder needs to be built on a mutual understanding of what our business is. So we need to understand the founder's business, but he also needs to understand why we are investing, what our challenges are with our LPs, you know, what types of LPs we have, where we are in the maturity cycle of the fund, and all of those things which generate a lot of anxiety for the VCs in terms of what's going to happen, and and relates back to the courage and the entrepreneurial aspect of the VCs. How does this play out in practice? Well, I think in practice, we try to, and then this is sort of what we do at Adara, we try to say all of this boils down to essentially 3 areas where the interaction with the founders can be very, very strong. One is on the funding track, because we've seen a lot of rounds. We've done a lot of rounds, not only the investments we've made, but the individual rounds within the investments. So we've done 40 investments, but that represents probably 250 or 300 rounds in those companies. So we've seen a lot of rounds, and and we've that's quite a big library that we can share. The other thing that we think we can talk about quite a bit with the founders is what we call one-time strategic decisions. Should I refactor the code? I think I've got this big issue on the technology stack, and I think we need to go into a big effort of refactoring the code. I'm sure everybody's heard about R4 at Oracle. That was a big deal for Larry Ellison when he decided to refactor the whole code of the core database. Those kinds of decisions are very, very important for the company, and we've seen those happen again and again. And while we may not be the right people to tell you what the right answer is, we certainly can help you understand what the process is to get to the answer, and try to help you build up the proper type of thinking process. And the last piece is what I tend to call the sort of moral support for the entrepreneur. I mean, entrepreneurs, first-time entrepreneurs, and even follow-on entrepreneurs are facing a world where their companies, if successful, are growing maybe 100% revenue year on year, which means that the company's basically tripling every 2 years, and in terms of people, they're probably growing, hopefully not at 100% a year, because otherwise they're continuing to lose money, but somewhere in the 60 to 70% per year, which means every 5 years, 3 out of every 4 people in the company weren't there 5 years before. So what it means is that these entrepreneurs are facing challenges in building up their teams and leading them that are really quite enormous, and subjecting them to enormous amounts of stress. And I think in that, having somebody that they can just talk to and share in an open and trustful relationship is very, very important. And that requires a lot of mutual of talking and building up that trust. Sometimes the trust does break, and when that happens, that basically crumbles, and it's very difficult to rebuild that. And it can break for many reasons, but that's why it's so important to diligence the people that are going to be with you. This is it's like a marriage, right? We really you have to diligence it as if you were thinking this is probably somebody you're going to spend maybe not more time than with your family, but the stakes may be even higher than that at some point. There will be moments in time when the stakes are really high in the relationship with the VCs you have.
You said a million things, Nico, that I want to dive into. But I do also think that there is this very general question of understanding the timeline of a fund and where they're at in their life cycle that you also brought up. Could you just speak a bit to it, the importance of that for founders when they take money, to understand where the fund is in their life cycle? And also very specifically, some VCs would say, well, I might only have 4 years left in my investment period, but if this company takes off, my LPs will let me continue. Don't worry. That's some people, some would say that, others would say it's not realistic. I need to liquidate my fund in 6 years, so don't expect that. I'd love to hear your thoughts.
Yeah, I mean, funds are well known in their mechanics, right? They're generally 10 years plus 2 years extension. The investment period is generally 5 years. It's not the same to be in year 1 as it is to be in year 5. And it's not the same, not only because of the timing perspective, literally you have more exit pressure. If somebody starts in year 5, you have less time to build and to develop. So you probably find, the good VCs will be doing a slightly later stage deals at the end of their investment period. But also, by the time, if you're the last portfolio company joining the portfolio, the VC is already sort of just putting the finishing touches on his portfolio, right? And portfolio construction for a VC is a very critical element. You know, a VC doesn't just do 10 deals completely independent without any relationship between them. He builds a portfolio. This is like, I don't know, creating a painting where you start doing that, you know, you put a first element in it, then you start adding the second. By the time you're putting the finishing touches on it, you are actually working on diversification, on time diversification, industry diversification, on types of founders that you have, on risk profiles, all of those things. And you want to engage the VC on really understanding why it is that he's choosing you for that portfolio at that time. Why do you fit well in the portfolio? Who are the other companies that are in the portfolio that you're in, et cetera, et cetera. If you're the first one in the fund, then, you know, basically you have the advantage that you're the first one on a clean slate, and that's slightly different, and therefore you should take that into account. But you need to inquire with the VC what the logic is, and push back and you know, and challenge them on, you know, why are you including me in this portfolio? You know, if your VC has a full portfolio of digital enterprise companies and suddenly you're a consumer player and they say, okay, we're going to do this deal, you should be like, why are you putting me in this portfolio?
Yeah.
You know, what's the rationale? What's the logic? And that's a very obvious example, but you know, when you see, you know, your company and you know how it'll fit, and within a portfolio, there's a lot of value that's added by the portfolio itself, by your companions in the portfolio. It's like a bigger family.
Yeah, we have a question here. Do you want to ask it live? No. We've got the question: how do you assess trust, and how do you make LPs or VCs feel that trust to the founder? I think it's interesting to talk about trust because it's so difficult to measure. And I also, maybe Nico, speak a bit to your adjustment or adaptation to COVID times where it was more difficult to meet people.
So maybe the second question first. I hated that because I like to sit with people. I like to go to lunch with them. I like to see how they talk to the waiters. I like to understand how they interact with other people. I like to go to their offices and see how the offices are laid out, how they, you know, where is if they have a PA, where does he or she sit? You know, what does their office look like? All these factors that are not possible on Zoom. And I think, you know, are very important. And I think founders should be thinking the same way. And, you know, if a founder's like, no, I'm doing my process only on Zoom, and because I want to talk to a maximum number of VCs, and all I'm going to do is give you 3 Zooms, you know, well, then, you know, I don't think we can continue this process. It has to be somebody that really wants to engage. And I think that real engagement only happens face to face. To the first question that you had, how do you build trust? We have a saying here down in Spain, which is, you know, trust is the last thing that you get and the first thing that you lose. So I think building trust is as much about not losing it as about building it. And there are a lot of small details that contribute to building up the trust, which is, you know, obviously always being very truthful, always being candid, being transparent. And by the way, being transparent can be being transparent about the things that you can't talk about, right? It's fine to say, you know, if they say, well, you know, what is your carry? How much carry have you made until now on Fund 2? I'll be like, well, you know, but when we're good friends, you know, we can have a chat about it, and I'll tell you. But you know, that's not something that I want to talk about now. No, but what that tells you is, you know, you start understanding the boundaries.
Yeah.
So, you know, through the questions that people don't want to answer and where transparency starts and ends, that's understanding the boundaries of people, which are very important in building up trust with somebody. You know, everybody has a boundary beyond which, you know, it's not about trust, it's about, you know, something else. And I think that's very important to understand. The other thing is, you know, you really need to be careful about the elements where you don't lose them. Like, for example, you know, that email that you sent out, that you did a copy to all, and you made some disparaging comment about something that is said in the last board, that's a killer. In the same way that if the VC does that, imagine what that does to your level of trust. So that's not a little detail. That's a pretty big killer, right? If you do something like that. But in the same way, even those little things where, for me, trust is built on the fundamental element of trust, and this is very personal view, is built on consistency. So when I see consistency in the messages, when everything builds on itself in a very strong and solid base, where you say, okay, everything that this person is telling me seems to fit, then you start building up trust. When something is like, that's kind of off, because they said that they were very interested in this area, but now they're being kind of more opportunistic and driving me down this, and why did they say that? Trust is a very fickle characteristic, or not a characteristic, but is a very fickle thing, right?
Yeah.
It's like sand. You can fill a bucket with it and it'll slip through your fingers in a minute. And you really need to make sure that you build it up steadily and surely. And obviously some of the basics are, do what you say you were going to do. Make sure that don't overpromise. So people that overpromise, generally it's a bit difficult to trust, because it's not that they were lying, but they just it's okay to fail, but don't voluntarily overpromise because you're trying to oversell, and don't play smoke and mirrors, and don't do any of those things. So
and I think that maybe just tie that, because we had a person asking, Gabor asking about pitch decks and what you're looking for, and in terms of diligence there, I think that trust is it's not necessarily built in the pitch deck, but it's definitely lost if you're putting stuff in there that I put these as customers, but in fact I've only just reached out to them and they haven't really speak to that a bit, Nico. Some of the things that you want to think about in the very early innings in conversations with VCs.
So you want to make sure that what you say at every point in time is going to hold for all the future conversations. So it's better to say less, but very straightforward and very truthful, than then have to go back on stuff that you had. And make sure that everything that you put in the deck is going to be effectively withstand scrutiny down the line. Like if you start dating somebody and you say, I'm a golf player with whatever the handicap is, a 3 handicap, and then okay, let's go play golf. I can't go play today because actually you get yourself into a big mess there. So if you've said I have this customer that's about to sign next week, that's a classic, right? I have Telefónica's about to sign. Okay, we've heard that 100 times. So don't say it. You say, I'm in a dialogue with Telefónica, and if you want a diligence in detail, maybe you can help me understand whether they're going to sign next week. That's what they tell me, but I'm not sure. So maybe I could ask you whether you think that that's a viable thing. So show weakness, admit to weakness, show weakness, admit to what you don't know. All of those things help build trust. I think somebody was
Aki,
if I can have one sentence.
Yes.
Thank you. Yes. Thank you. So I'm Hansa. Very passionate about your space. I don't really come from the financial space, but I know DC finance from New York very well, from Bryan, New York. So basically, my question was about again about trust. I think everyone is trustworthy, but isn't it that most people are afraid to say what causes clashes, or what their boundaries are, or what they don't like? Because in the beginning, they want to impress with their deck and get the financing, and they think that if they raise difficult questions, or if they raise their limits, or if they have any negative sentence, that this might discourage people from funding them. So how do you get about raising what would break the partnership charter? Thank you.
By raising it, and by being very honest about it. It's people that are upfront about the weaknesses and about what they don't know, or are doubtful about, are very quickly build a lot of trust quickly, especially when it plays out that way. Also because, you know, at this point of the game, you know, 20 years into the game, I can tell you that, you know, no deal is predictable, no future is predictable. You know, we can only assume best efforts on the part of entrepreneurs, and they can only assume best efforts on our part in terms of doing everything that we agree. And what we need to understand is that we will walk this together. You know, when somebody's constantly trying to convince you by an overblown sort of argumentation, like, you know, believe me, this is going to be incredible, we're going to do this, we're going to do that, it's very difficult, you know, because you're constantly selling the future. At some point, the future has to turn into reality. And, you know, if somebody's constantly saying, you know, we're going to achieve this, we're going to achieve that, and, you know, I know we didn't quite make it, but it's coming, it's coming, it's coming, that's a big killer. That breaks the partnership charter, right? Somebody should say, look, I think we're not going to make it. So what do we do? You know, and if somebody has a pitch deck, obviously if the pitch deck says, you know, I can't build a product, I can't sell it, you know, but I still want your money, then that's not going to work, right? We have to feel the vision, we have to feel that they can execute on it, and we need people that feel and have the confidence that they can build that they can engage the process of building the company, and we need to feel that they have the confidence, and that leads me to another reflection, which I'll come back to in a second. But if we feel that they have the confidence that they can build it, and that confidence is underpinned by some very strong beliefs on the positive side, but also very strong realism on the negative side, you know, these are the challenges that I have in order to achieve this vision, that is a very good situation, because we can talk about whether we can help with those. We can talk about what it takes to overcome those challenges. You know, a founder that comes to us and says, you know, I have this incredible vision, I'm going to be really good for the next 2 years, but I can tell you now that I need a replacement CEO in 2 years. Wow, that would be like, geez, you know, that very good, thank you. You know, the reality is we've had CEO transitions in 75% of our portfolio companies. So, you know, basically we know that everyone that sits in front of us, 3 out of 4 of those are going to go through CEO transitions, which doesn't mean that they lose their stake, that they lose their money or anything like that, right? It means that the CEO role within the company that they have founded, and they will be founders forever, has evolved, right? And that in fact, the transition to CEO is one where they will become stop being CEO to make a bigger pie, and therefore make the company bigger. Exactly what Bill Gates did with Steve Ballmer, right? 2 years in. So, you know, somebody who comes and says that right off the bat, that's not a sign of weakness, that's a sign of strength, right? And of confidence and knowing where the limits are. It's also about what you know. Knowing what you don't know is as important as knowing what you know. In fact, you at best, I think we can get to that point.
Yeah. Nico, there is a constant debate in the VC ecosystem about whether a VC is worth anything if they aren't founders or not. There are definitely VCs out there that proclaim that they are operator VCs, and they come with an operator background from startup X, Y, or Z, and anyone who doesn't have that type of background can't be good venture investors. I'd love to hear you commenting on this view.
That's fine. I totally respect that view. You know, they have a view. I mean, frankly, those that need to decide whether I'm a good VC or a bad VC are my limited partners. They are my customers.
I'm asking
therefore,
I'm asking because it's wisdom that's being touted to founders, right? And
Yeah,
here we have,
and what they're saying, I think, is, we have real experience related to what you're living through. We've lived what you've lived through, and therefore we can be better at it. It's true.
Yeah.
They probably can do a lot of stuff there. As founders, you need to be very cognizant about what the business model of the VC is. Who is his customer? Who is paying his fees? Who's paying his carry? And who does he eventually relate to? And who does he owe to as a VC? And everybody will say, I'm founder friendly, I'm founder this, I'm founder that. I can tell you, when a VC stops believing that you can generate returns for him or for his LPs, and therefore for him eventually, he stops paying attention. He or she stops paying attention. And that, anybody that says the opposite is lying, because that is the model of a VC, right? We make money because we generate returns, and we only generate returns on the companies that do well. I mean, there's no way around that. So we might as well admit that right now on the table. Now, how do we make sure that returns are generated better? Is by having a good partnership with the founders in the portfolio, and making sure that we build and that we optimize the value add that we have, that other investors have, that we bring to the table the maximum amount of value add for the company, and make sure that the company is successful. And that's the beauty of it. We're really aligned for financial success, which is why we always ask founders, are you, the cash or king dilemma? Do you want to be a king, or do you want the cash? Because we need the cash. So if you want to be a king and you want a big building with your name on it, then we cannot invest in you, because we need to sell the company. And we better agree on this before, because if we have to have this debate once we're invested, it's kind of a tough one, right? So, I think the whole point here is to make sure that you are clear on everybody's role and business model within the whole framework. Now, can a VC that's been a founder add a lot of value to a founder? For sure, of course. I mean, the library of that founder is full of things, to use the analogy I used at the beginning, that are very relevant to you as a founder.
Yeah. Going back,
but also I can tell you a lot of those may be redundant to what you have. So, I think with all modesty and we also have things to add as VCs that may not be founders. And that's why it's so important to look at the people and just, can you relate to the person that you're going to have on your board that's going to work with you? Can you build with them? Because, the library may be amazing, but if the librarian is an asshole, you're not going to read any of the books from that library.
Yeah, exactly. Speaking of libraries, especially in this period with higher valuations and VC funds still being the same size as they were before, and for that reason, VCs need to make their money stretch further, and that means that they're going for a bit less percentages oftentimes, and that means that you suddenly are looking at around not only being done by one VC or two VCs, but you're looking at multiple
More syndication,
VCs.
yes.
Yeah.
Yep.
I'm curious to hear your take on how founders should think about putting together such a syndicate.
I think you can use this situation as founders to build stronger syndicates. So look at it as, wow, now I have if I'm really attractive as a company, now I have the opportunity not of getting one fund, but getting two. So now for the price of one, I have two libraries.
Yeah.
And so, look at it that way, because you can force the funds into syndicating, because you have the ability to get a bigger round, and therefore they need to divide it up. And you should see that as a big opportunity to reinforce the level of the people around the table. And you don't have to trade off. You don't have to choose one or the other. You can get both.
And what now?
Or both, or more than two, right? You can get several.
Yeah. What if, whether we're going back to more normal times or not, you have the ability, that there's one VC is super happy about you. They want to invest, but they'd like to take the whole round. To what extent do you believe that the thought of creating a stronger syndicate with more investors is something that founders should pursue in most cases? or should they be just as happy with one and then say, you know, there's good reasons just to do with Adara. There's, you know, I don't have to bring both Adara and KFUN.
Look, if you can get, you know, if you can get Axel or Andreessen Horowitz to pay attention, or Atomico, and you're choosing between Atomico or Adara and KFUN, you know, with all the pain in my heart, I will tell you, take Atomico.
Yeah. Yeah.
But
how about, you know, if I could choose between Adara or Adara and KFUN, should I try and
I think we would be respectful of a fund founder that pushes that.
Yeah.
Because if it's rational, the rationale is the right one.
Yeah.
You know, it's always better to have, you know, bigger pockets around the table. And another big truth about the companies, at least in my experience, is that they always use more money than they think, and that we think too. That, you know, even so, it always ends up being more expensive, requiring more funding, requiring more time, more effort. It just, that's the way life is, right? On so many things. And
it's like a vacation.
And so you might as well admit that up front and say it's better to have big pockets, a bigger pocket or more pockets around the table. That's always a good thing. You know, if it doesn't come as a trade-off to the deal and you're getting the same deal but divided into several, if you can do that, that's great. Now, it's true that some VCs have minimal percentages, and so what you don't want to do is say, okay, what I'm going to do is take more dilution because of that. So you have to work the dilution equation so that it works for you and for the funds.
Another question, Nico, we've spoken a lot about portfolio construction, and I hope that everyone listening in realizes why portfolio construction is so important, and also maybe read a bit up on it. It is worth to understand as a founder. But Nico, I know that you're also one of the ones oftentimes saying, I'm not a unicorn hunter, I'm a dragon hunter. And I'd love to just to expand on that concept, and also say what the effects are on how you run your fund and what that means for founders.
Yeah, I mean, it's not sometimes, it's always. I'm always a dragon hunter and not a unicorn hunter.
Sometimes say it.
And what does that mean? I mean, just you know, I think everybody knows what a unicorn is, but a dragon is a different formulation. A dragon is a company that for a given fund returns the whole fund. So a dragon doesn't need to, if a fund has, let me put an example here. If we make an investment in a company, we have, you know, we start off with 10% of a company worth, I don't know, 20 million or 30 million. That company eventually becomes a unicorn, but our 10% is diluted down to 1% in the process, or 2%. And this is part of a 50 million fund. We get 20 million back on the billion, right? If instead of that, the company goes to 500 million, but we retain 10% of the fund, 10% of the company, we get 50 million back. And we prefer to be in those situations where we get we keep a bigger share, and we basically can return the fund, the whole fund. Now, this doesn't mean that we try to keep the company small. What it means is, what we try to do is keep our share as big as possible and manage our pro rata. So this is about the way we allocate to the companies. Now, what it means also is it doesn't necessarily, you know, we don't need the companies to become unicorns, because the dilution effect in a unicorn, unicorns are hungry animals, so you need to feed them a lot. And in order to feed them a lot, you need to do a lot of rounds. And a lot of rounds means a lot of dilution. And it means a lot of dilution for us, but it also means a lot of dilution for the founders. So the key here for a founder is, you know, you should be careful about doing the math on your business model and on your competitive view and all of those things about what it implies to just become a unicorn just for the sake of being a unicorn. And this is about financial returns. You know, what does your absolute dollar number look like in one scenario and another? And that's why we focus on dragons and not on unicorns, because we are focused on the returns, because our business model is to generate returns for our investors. You know, a unicorn hunter doesn't mean anything for an LP, because unless you make some assumptions about what your percentage is in those unicorns, it doesn't talk to what the returns are. Whereas a dragon hunter does talk to what the returns are. And so what I tell founders is, I say this because what this tells you is that my focus is to generate returns for my investors, and you need to know that. So I will always make the trade-offs as an investor in your company based on what it means for my investors. I'm not going to make them for what it means for you. I'm going to make them for what it means for my investors. And hopefully that's aligned. But you need to know that from day one, because that's my business model. And that's how I feed my family. So our founders need to understand that, those that want to work with me, and that I want to work with. And so that's why that understanding, if you ask them the question, if you ask your VC a question, are you a unicorn hunter or a dragon hunter? You can maybe have an interesting conversation with them about what that means. It may be an opening to have them talk about how they generate returns and what that means for their portfolio companies and so on and so forth.
But I would also think that's at least also part of the equation for me when I think about it, that when you are saying that I'm a unicorn hunter, that also means that, okay, you are going for that $1 billion valuation. So that also means that no matter how little or how much money I put into you, that's what we're aiming for. Whereas if you're a dragon hunter, I would think that you're also a bit more inclined to invest in businesses that don't necessarily reach $1 billion and doesn't have that as their ceiling or as the floor, actually. But
what it means is it doesn't need to be $1 billion to be successful. It's going to be incredibly successful for all of us if it's even smaller. If we've done it in a capital efficient way. And I mean, now the reality is that unicorns, are just all over the place, and we're minting unicorns like crazy, and so on and so forth. How many of those are on paper? How many of those are really going to be, real unicorns are the ones that not on paper become unicorns, but actually generate the exit. In fact, if you notice, 10 years ago, unicorns were exits at 10 million, and somewhere along the line, somebody decided to say, no, now we're just going to say unicorn when a round of $1 billion happens. There's a very fundamental difference between those two. Very, very fundamental. There's been no cash on the table for a large proportion of these unicorns. So you need to think of that understanding the frame, the way the VC thinks about this can open up a window for you as a founder in understanding how the VC is thinking. And it's a fun way to talk about it too.
It is.
It's a bit of a provocative way. I tell you, I've never had a founder yet ask me that question.
Now, but that shows, and that's also why I said what I did before with portfolio construction, that it is worth paying attention to. Nico, I'll go right to a question that we got here very much towards the end. So thank you for that, Stefan. I know Stefan very well. Stefan asks us, can you share a bit on how to bridge and how you look at that situation as an investor? And then he has some context about the fact that he meets many founders that are running out of money, and that is happening faster than they expected. And to him, as an outside investor, that can sometimes look like an opportunity being there on the table for him to come.
Yeah, I mean, these are opportunities, right? Because for outside investors and probably the inside, the investors that are in the deal will probably, be very happy to see somebody take an interest. I think you have to measure and be able to diligence whether the situation is one of transitory. Sorry, I've got somebody leaving here. Is a transitory one, or it is a fundamental issue with the business model and with the company, right? So, everybody understands that sometimes bridging is better because you're actually bridging to get a better outcome in the round, or because you need a bit more time to demonstrate, or because, and things do take longer. So, it's natural that happens. It happens very often. So you shouldn't be ashamed of saying, I need to bridge, because it's just a very natural course of business, right? It's like people buying a house. I need a mortgage. Doesn't mean you're poor. It just means you need some of your future earnings given to you today so you can buy the house today, not when you're 80 years old, right? So bridging is a similar concept. Give me the money today so I can get a better outcome in the round going forward, and that will be helpful. And if if the fundamentals are sound and you can convince on that, then those can be good opportunities. We internally, as in companies where we are already investors, there are a lot of bridging situations. And that's exactly what we try to understand. Is this do we have a fundamental problem, or is it a timing problem, or is it, just it's taking longer, or what assumptions did we make at the beginning of the round that aren't playing out and that we need to fix?
I think that just around the conversation with the founders, because you often have visibility of the fact that, okay, bridge round is going to be needed, and then the founders has that as well, and then they're seeing, okay, but should we do it as a bridge, or should we do it as an actual round? What valuation should it be on? I spoke to one just the other day who was planning to do a 2x bridge with his existing investors in 3 months, and then he had in his plans that he should be able to do quite a bigger multiple on a Series A in just another 9 months. And I said, there's something wrong there, because your bridge is done at 2x, and then you're expecting in 9 months that you will be able to do an A round with a considerably larger.
So if it's a bridge, I mean, you have to decide whether it's a bridge or an extension.
Yeah.
An extension is tagged to the prior round, and a bridge is tagged to the future round. So the bridge to the future round should be at a discount. So it's probably a convertible at a discount to whatever you negotiate in the round, because you're thinking of it in a temporal horizon of when does the next round happen. If it's an extension to the prior round, it's what accretion of value do I have since the last round, if any? Did we just make a mistake and the round was too small? Well, then there should be really no increase in value, right? Because the fact is, we should have put this extra money in before. So the round was just wrongly dimensioned at the time. If it's because there's been an accretion of value, we've realized that actually we could, if we had more time, we could increase that accretion of value, then you should probably reflect that accretion of value in the multiple and say, I'm doing it at 50% uptake or 2x or whatever you want to put in there, or whatever you can negotiate. But conceptually, that's what it is. If you're looking forward on a bridge, then the discussion is around what discount, and the discount is a fraction of the time, because it's literally, what discount rate do I need to apply to the money on the risk that I'm taking? And if it's an extension, because we basically did, the round was too small, then you need to think about whether you're adding or accreting to it. That's the framework we use in thinking about those things. And I think it's helpful to talk it that way with your investor. As a founder, if you put it to them that way, it helps you understand how you want to frame it as well, I think.
Yeah. Nico, just before we round off, we're going to do an extreme quick fire. Some of these questions, they haven't taken them earlier because they aren't tied to the topic of today. So out of respect of the topic of diligencing investors, I didn't want to bring them up, but let's do them in a quick fire now. First question is, what is more important, traction or revenue?
Revenue traction.
I love that. In terms of traction,
traction.
Yeah, because it's a leading indicator. It can be other things than necessarily revenue. In terms of traction, which is more important, actual nominal figures or growth rate?
Well, at some point, the growth rates need to turn into, nominal figures. So I think actual numbers are important.
How detailed should the financial plan be? 3 years, 5 years, monthly figures, half a year, yearly figures? What do you need?
Next year in detail as a budget. And beyond that, it's all aspirational, revenue and a view on the financials. Very, very high level. Detailed 5-year financials are not that helpful. They're not going to play out. So,
yeah. Nico, how do you get founders to upskill their risk taking and their long-term thinking?
Well, if they need to upskill their risk taking, we've probably made a mistake. So we need risk takers, right? We need people that are willing to go out there, and generally they are, right? So founders, we don't generally feel we have a problem in founders not taking enough risk. Sometimes we have to kind of down risk them rather than up risk them. So I think that's the first part is not such. We don't see that problem so often, Sometimes we do see situations where founders want to exit too early. And that's dialogue, talking to them, trying to make them comfortable. Sometimes it involves giving them, partial. We're seeing a lot now of beginning to see realization for founders. You can't have a founder sitting on $100 million company, not having seen any money in his bank account. So I think the views are changing on that, and you have to let the founders begin to realize something along the way. So there are ways to manage that as well. So you manage their anxiety, expectations, et cetera, et cetera.
And long-term thinking, final question. You have 2 words to say it.
How do you drive long-term thinking?
Yeah.
Don't talk about short-term.
Yeah, good point.
I mean, don't listen to the short-term and just.
Anna, you're right. Some investors keep asking about where's the money, and that's what you can't do, at least if you need to drive long-term thinking.
Yeah, it's always a balance. So you have to be talking about both things, and because without the short-term, there is no long-term.
Yeah.
Nico, thank you for availability. Thank you for answering the questions. It was super interesting, super cool, and that Andreas and I really appreciate your time. It's been a pleasure so far.
Thank you. It's been a pleasure on my side. An honor to be able to talk to you all. Thank you very much.
Awesome. Thank you everyone for joining us. Yeah. Stay safe, and see you in the next one coming.
Thank you.